Good morning, Ron. Good morning.
Morning, Kath. Morning, everybody.
Yeah, welcome to the Baby Boomer Investing Show, and we've got a great show today. Today, it's about
Another great one. They just keep
another
on
one.
coming.
Yeah, it's about the double whammy, rampant inflation and global stock market crash. So
Yeah.
what are we gonna go into first here, Ron? Do you want to explain anything about what we're going to be seeing?
Yeah, sure. So I get emails like everybody else on this call, and more, especially today. The emails are all about inflation is on the way. The Biden administration is printing money. Look out. All that warning's going on. The warnings about the stock market bubble are so understated. And we've had an episode, we call it gaslighting. And Wall Street is gaslighting us. They're telling us, don't worry, it's not a bubble. Everything's going to be sweet. That's just plain BS. So
Hooey, that's a bunch of hooey.
it's a bunch of hooey. So what prompted this idea? Actually, if you want to go to the third slide, Kath.
Okay, I'll do that right now.
I think earlier I said to skip the first two, but first one.
Okay, we'll go to this, and here we go.
Great. So I wrote an article. It was published 2 weeks ago, called "Bursting Bubbles Blast Baby Boomers." If you can say that after you had a few drinks.
Bursting bubbles blast baby boomers. Wow.
That was the thought, that I could make it challenging to say, but it got a lot of readers. The article really went into this idea of being gaslighted, getting in touch with the fact that bubbles really do exist. But not only that, they're going to burst. Bubbles cannot inflate forever. They rarely burst because they've been overinflated. There's normally a pin that bursts them. So I'm going to talk about the pins. There's 10 of them. But importantly, the question sort of came up as I was getting all these readers is, do baby boomers really recognize that they need education? I mean, after all, they're adults. They've been alive for a long time and should be fairly smart. And I think the answer to that is actually in a Will Rogers quote. And he said, everyone is stupid, but about different things. So we have been routinely addressing baby boomers who I think most of them rely on other people to make their investment decisions. And on the next slide, Kath, I think this is really critical to our show. We are the only show for investors, for educational and financial education for baby boomers.
Gives
and
me
I've been looking.
Gives
Well,
me
I've been looking
goosebumps.
for 6 months now. I Google and look, and some are reasonably close. They're in Canada, but it's not their mainstay. So the baby boomer shows that are around now will help them spend their money, help them travel somewhere or buy a house or get a reverse mortgage, and those are all good. Those are all good. But I think what's really happened here is most of our 78 million baby boomers have relied on advisors. And one of our shows, our third show, which is one of the most popular shows, is the 70-year history of investment consulting. And we explain in detail why the pat answer is 60% in stocks and 40% in bonds. And that is reasonably good for younger people, but just not right for most baby boomers. And I'll just remind people on the next slide, Kath, why it's not right. And this is just so critical. And I guess what I'm saying is that I think we're the only ones that are saying this loudly. And that is, we all go through life where when we're investing, the risk of loss turns into the risk of ruin. And as we transition from our working life to retirement, this green light here line is our savings. So our savings grow, and then it comes in a time in our life when it's time to spend those savings. Now, some people will have a retirement plan, a defined benefit retirement plan, where this line might not be true because they'll be getting an annuity, which is very nice. But today we are now experiencing what it's like to be on your own to fund your retirement. So defined benefit plans are almost all gone. There's only a few of them. So for most people, this pattern that we're showing here is for them. So they are, if they're, let me put it this way, most of our 78 million baby boomers are right now in what's called the risk zone. They're about to leave their working life, or they are already in retirement and sort of easing in. And the 5 to 10 years before and after retirement are called the risk zone. And there's a concept called sequence of return risk. And this is really hard to get your head around, but it turns out that if you were unfortunate enough to lose money in the risk zone, the most likely outcome is that your standard of living will be reduced. And then it's a matter of how much the reduction will be. And what we're going to talk about today is that these bubbles are inflating. And right now, I think everybody feels good. But I'm going to tell you about the magnitude of the correction that very easily could happen. And it's just mind-boggling how bad it could be. So baby boomers really, in terms of their investment objective, right now, that objective should be to not lose their lifetime savings. They should be trying to protect their assets. And they're not being told that. 60-40 is what they're being told. So our mission in when we started this last year in February was to try to get the word out and try to help our fellow baby boomers. Now, some people are going to listen to this and say, I can't make any money being safe. And that is an unfortunate truth. I mean, it's really hard to make any money, but better to not make money than to lose a lot. And so that's really where we're at right now. And at the end of this show, I'm going to promise to tell you something, and that is when the bubble is going to burst, how bad it's going to be, how bad inflation is going to be, and what you can do to protect yourself. So, Kath, you're sending me these videos, and people are getting millions of views on topics like this, and they're almost always selling gold, or there's something they're selling there, and
right, they're selling something.
Yeah, we sort of are, but we're basically we're offering for a small fee some investment advice, but that's not what we're selling. So I'm going to talk about, first of all, the bubbles. So if you want to go to the next slide, Kath. Bubbles. They're so pretty.
Yeah.
So some thoughtful people are really sounding the alarms on bubbles, and they're not selling. And Jeremy Grantham is one that several people have sent me his video, and it's very well thought out and persuasive. Adam Taggart is a fellow who owns Peak Prosperity, and he does a show every week and invites guests. It's mostly about bubbles. Harry Dent has really gone out on the limb, and even I'm going to use him at the end here, but he has pinpointed the month that the bubble is going to burst and how bad it's going to burst, which is really interesting. So here's what we're going to do with the bubbles. I'm going to show you 7 proof statements that the bubbles exist, because there's been, again, this gaslighting thing that's going on, which is plain hooey, like you say. I'm going to show you 15 reasons. So people go irrational exuberance, people are crazy. There are 15 reasons, every one of which you will understand. And you will say, yeah, I agree, that's actually going on. And people aren't really crazy. I just think right now there's a little bit of behavioral scientists tell us that we have a lot of built-in biases. And confirmation bias is one. Recency bias means that we think whatever happened yesterday is going to happen tomorrow. There's a whole litany of biases that are just part of human nature that I think right now are fueling the bubbles. Then I'm going to show you the 10 pins, and I'm going to show you 8 ways to protect yourself. So let's start with a bubble. Kath, we used this slide in one of our earlier shows, but I went out and I said, how much would I pay for a pair of designer jeans today?
Yeah,
I really
right,
didn't
with
know.
holes in them. Yeah.
Yeah. $1,300.
Right.
Now, there's an aspect of a bubble, and the whole idea of a bubble is that the prices are way too high, that the value just is not there for the price.
It's good for the person selling it.
Yeah, and people are making money, and I mean, I can imagine that just off the top, if it costs more than $5 to make that pair of jeans,
Yeah.
it would be a lot.
Yeah.
So it's marketing, it's hype, it's all sorts of things, and these jeans are obviously selling because they're on the internet and they're there. I can click a button and buy them. So the sort of an early sense of where the bubbles are is if the price feels too high, it probably is. And just a common sense measure would tell you the bubble is there. But there are sophisticated measures I'm going to go through on the next slide. And probably the one that's being quoted most now is Warren Buffett's measure. And his measure of overpricing, things being too expensive, has successfully predicted just about every market crash there's been. And it's a pretty intuitive measure. He basically says if the market value of the stock market is higher than the GDP, gross domestic product, I'll start with the ratio. Take the market value of the stock market divided by the gross domestic product, which GDP right now is around $23 trillion. If that ratio is higher than average, then that's indicating a bubble. The average ratio is about 80%. So the stock market normally runs around 80% of GDP, which at $20 trillion would be around $16 trillion. The stock market today is 40 trillion. It is running way above the average. And a lot of people are talking to that. I'm going to show you what that looks like. Then other measures of expensiveness are, so when you buy a stock, you're buying its earnings. And the notion is, are you paying a reasonable price for those earnings? So there's a measure called the price earnings ratio. A similar thing is, are you paying too much for the book value of the company? So there's a price to book value. Are you paying too much for the sales of the company? So there's a price to sales ratio. And then there's the concept of enterprise value divided by sales. Is that high? And then finally, there's sort of the quantitative people in this space. They're called quants. You have this thing they call a Q ratio, which is if you're paying too high relative to what you could just replace the whole company with, that's another measure. So we are being gaslighted. And the word gaslight, by the way, is intriguing. It derives from a 1938 movie where Charles Boyer is the husband, and he convinces his wife, Ingrid Bergman, that she's going crazy. And he does it by just denying any sense of reality. So if she sees black, he convinces her that it's white. And that's really what's going on here. With all these Wall Street firms are predicting a terrific 2021. They never mentioned even the hint that there's a bubble, and certainly not that money printing. In fact, I'm going to come to this, but the Fed intervention is a savior, and that's one of the many reasons that the stock market is going to go up, because the Federal Reserve is going to buoy it up. So let's go through the details of the expensiveness measure. So we'll start with Warren Buffett. And here's what the stock market looks like. So coming into 2021, the Buffett measure, the market was at 3,500, the S&P 500, and its value was 180% of GDP. So well above the 80% that is the normal. So already we were getting a signal that says really, really expensive. But then the correction happened in March, and that brought the ratio down to 120%, which is still really expensive. But people like me started saying, great. So now we're going to get back to more normal circumstances. We call the COVID the match that lit the overvalued tinder. And we thought, that 120 was just the beginning. It was going to go back down to 80% of GDP. But that didn't happen. From that point on, the speculation at first was, are we going to get a V recovery? We got the V recovery. And we got it in just an incredible way. We recovered from that March correction in 4 months. The average time to recover from a correction is 4 years.
Wow.
So we just sort of bounced back like, just gangbusters. And not only that, but this is really the telling thing. Today, I can say this, in the last 11 months, from March of 2020 through to today, the stock market is up 76%. 76%.
Wow.
The average return on the stock market over 11 months is about 8.5%. So a statistician would say this is a 3 sigma event. This 76% return is just way off on the right-hand tail of the probability distribution. It's incredible. And when I first look at this, I go, wait, I think I'm not doing this right. It's real. We have bounced back beyond belief, 76%. So right now, in terms of the Buffett measure, we are at 220% of GDP. And just on the bottom panel here, a little fun with numbers, but it's that 220 is 275% of 80. So we're at 275% of normal. And in order to get back to the 80, we're going to need a 65% correction. So that's sort of one number to keep in mind. How much of a correction do we need to get back to what's a reasonable price? Could be 65%. If we wanted to get back to where we were in March of last year, this is the fun with numbers. So we're up 76%. You would think we need to lose 76% to get back to that March level, but the number turns out to be we need to lose 45%. It's funny how the losses really work. You need a much bigger gain to get back a loss. But so the 45% loss would get us back to March of last year, which we all thought at the time still wasn't enough of a correction, and maybe another 20%. So the Buffett measure is very much signaling a bubble. Then on the next slide, I'm going to show you 4 measures that this fellow named Lance Roberts, who's a really well-read and thoughtful guy, he said, I'm going to measure it 4 ways. If you don't like price earnings ratio, I'm going to do price to book. I'm going to do price to sales, do enterprise value to sales. And the way you read this chart basically is anywhere you see a red, things are too expensive. And I should just tell you straight away that yellow is not clearly, maybe not too expensive, but green is fairly valued. And there's not many greens on this chart. And if you just want to spend some time, the 2 economic sectors where, by these measures, things were reasonably fairly valued were in energy stocks and in financials. So there may be a couple of economic sectors that are still reasonably priced, but the majority of the market is well overpriced and expensive. Then finally, the last proof that there is a bubble. I don't know how many proofs people need, but here they are.
Yeah.
This last one was in a publication called Advisor Perspectives, which is a really good publication. So that's on the next slide, Kath.
Okay.
And this article that I'm talking about used 4 different measures, but I'm showing you a slide here that just took an average of the 4, and it included this Q ratio, which is enterprise value to fair value. It's at 190% of normal, and this being more of a quant publication, that is more than 3 standard deviations above normal, and that what it really means statistically is this is never supposed to happen. It's beyond belief. So again, the 7th measure of things being overpriced and overvalued. So you look at all these and you say, so why is it that way? What's causing that? So the next slide, and I'm going to spend a lot of time on this. There are 15 reasons I can think of that we have a bubble in the stock market. And I'm going to go through each one. And if you guys are on Facebook, you can sort of respond to this. And if you feel that I've overstated or misstated or there's more, I'd love to hear from you.
They can actually respond on YouTube as well, too.
Oh, I didn't know that.
Oh, yeah, sure. There's a live chat on there. Yeah, as a matter of fact, it looks like all of our viewers are on YouTube. So please, folks, feel free to respond to Ron.
Yeah, great. So number 1 is, and I think this too, I think the vaccines are going to cure the pandemic. There's certainly concerns now about variants and all that, but I think we'll get there. So that one's, I think, a reasonable belief. But secondly, there's this belief that once the pandemic is behind us, that it will happen quickly, like almost overnight, and earnings are going to soar and the economy is going to recover. That's just not true. there are going to be remnants of the pandemic with us for at least 2 years. And everybody thinks that, except people are trying to price stocks. The third one is that the Federal Reserve is our hero, and they have committed to do whatever it takes to keep the stock market in shape, and the economy in shape. We're going to be talking details about the trillions that they've committed. There's a limit to what the Federal Reserve can do, and they are going to fuel inflation. And that fueling of inflation is going to cause some serious problems, and it will probably lead to it's one of the ways to get the bubble to burst. The fourth one is interest rates will remain low. And this is the one, by the way, that is in virtually all of the Wall Street commentaries, that it's different this time. Interest rates have never been lower, which is absolutely true. Interest rates have never been lower. Definitely true. And that means that stock prices should be higher because people value stocks by forecasting their earnings and then discounting those back to today using interest rates. So if you have low interest rates, the discounted value is much higher. So two responses to that. What I'm going to say is this number 4 is just total malarkey. I estimated how much stock prices should increase as a result of lower interest rates, moving from roughly 2% to say even 0.5%. That should increase stock prices by about 50%. So that's a big increase. But over the last decade, stock prices have increased by 400%.
Wow, really?
So part of that increase is lower interest rates, granted. The other thing that is really points out the malarkey, that's all built into current prices. So to argue that the current low interest rates are justifying increases in prices from here is wrong. And in fact, interest rates are starting to go up now. So just the reverse should happen. Stock prices should go down. And actually, stock prices went down a little bit the last 2 days. The next one is investor behavior. And fear of missing out has been in all the literature. FOMO is real. Is it exuberance? No, it's fear. And it's real. I mean, investors may see that the bubbles are going to burst, but they don't want to miss any part of what might be left in the bubbles inflating. The next one, the sixth one, is investor euphoria. And I saw this word, and I think it's really cool. It's actually mainly the millennials, and they're taking this hopium drug. It's the drug that gives you hope that the future is going to be bright.
Yeah.
You want to say something, Kath?
No. I was just agreeing with you. That's all.
Okay. All right. Foreigners have really flocked to the U.S. stock markets like never before. So I don't remember the number, but the big percentage now of the holdings in the U.S. stock market are held by non-U.S. people. And they are concerned, as they should be, about the devaluation of their currencies because the world's in deep doo-doo. There's a global debt problem. And the common view is that the U.S. is the cleanest dirty shirt in the laundry basket. And we are the official trade currency, so we've got that going for us. So that seventh one is true. 92 million millennials have never seen a market go down. So in 2008, they were not invested. And now
that's right. That's right.
So from their perspective, this recency bias is, the quotes that people throw out when markets correct are buy the dip because now things are cheap and stay the course. And that, I think, is very much in the millennial mindset. Not only that, but because there's these trading systems now like Robinhood and Reddit and what have you, they can buy a lot of stocks on just a little bit of money using margin. So they are leveraged. So they're borrowing to buy stock. Then the ninth one, this is well documented, the FANG stocks. Facebook, Apple, Amazon, Netflix, and Google have become more than 30% of the U.S. stock market. They become huge. And that sort of reflects, I think, a belief that if you're trying to catch the last part of the inflation in the bubble, that the place to be is in these mega stocks. So the FANG stocks are a big part of why it's going up. Sort of a really big example of that is Apple is now worth $1 trillion. And $1 trillion is about the size of the entire Canadian stock market.
Wow.
So, yeah,
Oh
yeah,
my gosh.
Apple, with that one stock, is bigger than all the stocks in Canada. And then this has been written about a lot. Tesla is now worth more than all their competitors combined. You had GM and Ford and Chrysler and put them all in there. That still is not as big as Tesla. So
Yeah.
that that one I will say is crazy. That one is, God knows what the heck's going on there. The 11th one is the election, and the stock market has gone up since Joe Biden took office. So I think there's sort of a belief that he's going to be good for the economy and for the stock market. This recent one now is sort of, it's been fun to watch, that the Reddit people, the robo people, can beat Wall Street at their own game. So they did a short squeeze on GameStop and also on silver. The thing to just realize about that is the people who start that are playing a pyramid game. So when you beat the short sellers and cause the stock price to go up beyond a reasonable price, you want to be the first one out. You don't want to be the last one, because that price is going to come down again. It's not going to stay up there. It's just because it's not a fair price. The 13th one is definitely true. Companies have been buying back their stocks. And what that does basically is increase their prices. So if you can borrow at 4 or 5% and the company's growing at 7 or 8%, that's really a smart thing for investment company executives to do. And they've been doing a lot of it. So that's been increasing stock prices. Then these special purpose acquisition companies are they were around for a while, but they've now become popular. And it's what's called a blank check company. You don't know what they're going to invest in. They're like venture capital investors, but nothing on the books yet. You're just betting on them that they know what they're going to do, and they're going to acquire companies that will make money. And then the other thing that's picked up lately is initial public offerings. So a lot of companies lately are going public because they can, because there's this appetite to pay a lot of money for not much value. So all those things, 15 of them. And if anybody on YouTube or Facebook can think of another one, we'd love to hear it. But
Well, we do have a comment, Ron.
oh, good.
This is from Greg. He says, I believe that non-U.S. investors have been a significant driver of our U.S. equity market returns the past decade. Great point, Ron. Thanks, Greg, for participating.
Thanks, Greg. Yeah. So all 15 of these, I couldn't even begin to tell you how much any one of these have really contributed, but collectively, they're this is the biggest bubble ever by most people's estimation. So then there's one more bubble I want to talk about, but it's an easy one.
Okay.
There's a bubble in the bond market, and there's only one cause, and it's the Federal Reserve. And if you're going to borrow a lot of money, one of the things you'd really love to do if you can is to not pay interest. Wouldn't that be wonderful?
Yeah. Yeah. Right.
But that is what the Federal Reserve is engineering.
Uh-huh.
They are forcing near-term interest rates to be zero. And there's even a name for it. It's called ZIRP, Z-I-R-P, zero interest rate policy. And they can print as much money as it takes to just keep those interest rates low. Now, I think, and others are starting to say this, that where that whole structure is going to finally collapse is not on the short end of the interest rate curve. Longer term interest rates will finally give way, and I don't think the Fed can stop it, because that part of the yield curve is priced by investors, not by the Fed. So I think they might try, but I think that's going to fail, and that's going to be one of the things that can burst the bubble. So let's go to the next slide, Kath, and just talk about this for a second, how important interest rates are. Oh, I'm sorry, they skipped one. So in our second episode ever, so we started this in February, late February, we talked about the dangers to the economy and the stock market.
Of last year.
Last year. Yes, I'm
Yeah.
sorry. Yeah.
Yeah.
Not yesterday, but
Yeah.
February, a year ago today.
Yeah.
And there's 10 of those, and I can go through them. But one of the things I love to talk about is COVID at that time was just beginning to be recognized. It's certainly not yet declared a pandemic, but we had that on our list. And it's still definitely there. So COVID could still burst the bubble. I mean, there's still things we don't know. We're learning every day, and any one of these could. But I think what's really going to do it is there's a global debt crisis. I think it's going to fuel inflation. We're going to be printing money. That's going to fuel inflation. And eventually, interest rates will not be able to be maintained anymore. So on the next slide, I just want to talk about how important interest rates are. And so I think other things could burst the bubble. But my best guess right now is that the zero interest rate policy is going to not work. That it'll give way. And people are already starting to talk about this. I almost have to laugh. So 10-year treasuries have gone up to 1.3% from roughly 1%. And they're going, interest rates are up 30%. Well, they're not up 30%. They're up 0.3%. You know, at 0.3 is 30% of 1. That's true.
Yeah.
But so that little bit of increase in interest rates is already getting a lot of attention. I just imagine, you know, if interest rates go back to a more normal level, like 5 or 6, or, you know, in the 70s, it was 18%. It's going to cause havoc. And this whole house of cards, the next slide has this house of cards thing, which.
Wait just a second, Ron. We got something here from Marty. He says, "Great show as always, Ron and Kathy. How can we comprehend values of various cryptos and their relationship with traditional valuation metrics and correlations to flat currencies, USD and others?"
Yeah, it's fiat currencies, Kath, but
fiat currencies.
Yeah.
Okay. Sorry.
So
I'm the by the way, I'm the one that doesn't know about the baby boomer stuff. So I'm the one that's learning.
Well, you
I'm
know
the
a lot of
audience.
stuff. You just don't know about investing, Kath.
Yeah.
But Kathy is my sister. So 3 shows ago, we had an expert on Bitcoin, cyber currencies, Maury McCoy, and he did a great job. But in a nutshell, you really need to think about the concept of money. What is money? And Maury did a great job in this. So the 2 things that I think make sense are, one is it's a store of value, and second is it's a means of exchange. And fiat money only works if we all agree to accept it for goods and services. If we have serious inflation, that store of value will not be there. And the quote that I saw about Venezuela, which is really true in Venezuela, billionaires became penniless. So the thing about Bitcoin is, what can you do about this threat of the pieces of paper in your wallet being things to light your fire with? Well, one of the things is Bitcoin. We're going to talk about other ways to protect yourself. Whether Bitcoin will work or not is a big question. But I think Maury did a fairly good job of just saying where it could go in value, why it's preferred to something that can be controlled by the government. Bitcoin sort of has a whole sort of thing going on there on the internet where its price is really driven by the supply and the miners. And this part of the arithmetic I didn't really follow, but the supply of Bitcoin can only go up so much per year, and the miners can only really produce so much per year. So there is a limited supply, but I don't want to sell Bitcoin. I just think it's one of the things to consider in protecting yourself against this threat that I think is real and is on the horizon.
Okay, so Marty says, I understand potential of blockchain for improving trusted or trustless transactions and improving digital ledgers with immutable
features, etc.
Immutable features, etc. But he says, but when applying a cool new protocol for improving transparency and trust, but this whole crypto stuff seems insane.
Could be. It really could. So, Maury, I think, please watch our show and then see if that does it. But we only had an hour, and we could have spent 3 hours. I listened to another video maybe a month before our show, and I can't remember the guy who did it or anything else, but he goes, go to our website, and in 40 hours, just watch our 40 videos. They only take an hour each, and in 40 hours, you'll understand cryptocurrencies.
Oh,
I swear, you said.
Yeah, right. Well, when we did the show. Wait a second here. When we did the show, I was amazed by it. I'm sorry. Here's your next slide, Ron.
Well, I think bottom line is the word trust. I think is really important. But I think with fiat currencies, trust is number one. With the cryptocurrencies, I think hope is just another thing there, because nobody's going to spend the 40 hours to understand it.
Right.
So this is just not going to happen.
Yeah, they're going to follow the leader.
Yeah. And what's gone on here lately is big firms have Tesla just bought $1 billion of Bitcoin. So just the fact that major players are jumping on it, I think, gives you sort of a warm feeling.
Right.
They could be wrong, but I don't know.
Yeah.
Yeah, I believe. Go ahead, read it, Kent.
He says, I believe each year only half as many Bitcoins can be created as the previous year. So very much of a limited supply over time.
There you go. Yeah, so that came up in the show. Gold has the same thing. I mean, there's only so much gold in the earth. And so we have this sort of store of value thing going on. And certainly gold would be another one, precious metals. But Bitcoin is just in the list of things that you might want to consider as protecting yourself. So let's talk about the tumbling in the house of cards.
Okay. All right. Now for the slide.
There you go.
I put it up a little too early, folks.
No, that's no problem. So this is one scenario, and I think there's others. I mean, just for sake of to really go out there, if we had a dirty bomb go off somewhere, this could trigger, bursting of bubbles and everything else. But one sort of gradual thing that could happen is stock prices start to go down because earnings are now discounted at higher rates. So interest rates have gone up. But we're going to talk some about modern monetary theory, but it is the license that politicians are using now to print money. And modern monetary theory it's not modern and it's not a theory, but it basically says that an entity that can print money should do as much of that as they can, but be cautious that if it causes inflation, to take that money out. Now, the sponge that brings the money back out of the economy is taxes. So I guess I already said my opinion on monetary theory. I don't know if our politicians will have the political will. So the idea now is they're printing all this money, and they're going to be on the line if they're going to follow the quote theory to monitor inflation. And if it heats up, they need to raise taxes to go along with the theory. So time will tell, but I don't think they're going to raise taxes. I think we're going to get inflation. So the second thing that happens when interest rates go up is the interest payments on the debt take away from other government programs, like Social Security and Medicare we're going to talk about. But what will finally happen is the government will do what's called monetizing the debt, which means they'll print more money to pay the interest, which will raise the interest rates, which causes them to print more money. And so you've got the spiral. And that's my personal view. I haven't seen many people really espouse this, but there you have it. That's what I think. So on the next slide, Kath, let's talk about the two things that will raise interest rates. There's the debt crisis that has been going on for quite a while. It's around the world. And then this money printing is really now taken on real significance with the COVID. So let's go to the next slide and just look at what the debt crisis is. So over on the right-hand side of this, we had Professor Lawrence Kotlikoff on our show last time. And he's the one who's really educated the world on what he calls off-balance sheet debt. And what we're showing here is the GDP is running around $21 trillion. The official debt is $27 trillion. And even with just those two numbers, people are already saying, so our debt is more than 100% of GDP. It's terrible. Well, that's dramatically understating the situation. If you put in what Larry calls the fiscal gap, which is basically the difference between what we've promised for Social Security and what we're expecting in taxes for Social Security, that right now is around $29 trillion. And the government, the CBOE, the Congressional Budget Office, is forecasting that it'll run out of money in 2026. Medicare is $47 trillion, forecast to run out of money in 2034. So you add all those up, and our total debt is $103 trillion, which is scary high.
Oh my gosh.
But we're not the only ones. And I wrote an article that one got a lot of reads. The global debt per capita is around $200,000. Now, if you'd use the official figures, not adding in the off-balance sheet, it's $87,000, which is still pretty high. But if you add in all this off-balance sheet stuff, that the world is broke. So this global debt crisis is for real. Now, when I show people the graph on the right-hand side, they say, what's that 2026 number? What is that all about? Well, don't the government just print some money? And the answer is it probably could. And same with Medicare. So let's just put that aside for now and just question if there is some limit to the amount of money that we can print without breaking things. So I think the game we're in right now is to print and print and print. Japan sort of led the way. They started like 5 years before we did. And people point to Japan and say, well, they're not broken yet. Well, their economy is sucky. But
yeah,
they haven't caused hyperinflation yet. But I think we're pushing on it. And I'm just scared to see what happens when we push the bear too hard. So the next slide, this is the thing with COVID. Damn it. Okay. I'm sorry, Kath. I do want to cover this slide. So if we print money, it's not really running the printing presses. The thing that's going on now is we manufacture it out of thin air. So when you guys got your relief checks, I got mine. It said U.S. Treasury on it. So the Treasury issued the check. Where did they get the money from? Well, they borrowed it. So the Treasury issues Treasury bills, Treasury bonds, and normally there's a sufficient interest there to buy those. In particular, people normally talk about China and Japan being major buyers, and they are. But let me tell you that China is only holds $1 trillion worth of Treasury issues. Japan holds a little bit more than $1 trillion. But the vast majority of the 27 trillion that's out there is held by others, and in fact held by the Federal Reserve. So when the Treasury issues don't clear, the Federal Reserve buys them, and so we're robbing Peter to pay Paul. Now, what happened with in 2008 when we started printing money is called quantitative easing. We printed about $5 trillion in 3 phases. And people go, well, that didn't cause any inflation. So modern monetary theorists, they're right. I mean, everything was great. We headed off a recession. The machinery of the economy was grinding to a halt. It was wonderful. I mean, we should do as much of that as we can. Well, there's a reason why the CPI measure, Consumer Price Index measure of inflation, didn't move. And that is because most of that money went into the securities markets, into stocks and bonds. Now, I was saying this about, 6 months ago, and I was being told that I'm nuts because that's not what happened. There was no inflation because there was no velocity. Well, yes. I get that, but yet that money had to go somewhere. it went into stocks and bonds. So
Yeah.
people now have been calling that price inflation. And that's, I really think, part of the bubble that's going on in the stock market and the bond market is that where the money went from quantitative easing. Now, the new COVID money, much of it, no, this is really a hood too. So the 1.9 trillion that they're talking about doing, that would be $6,000 per person if they just send us checks. But we're going to get $1,200 each, not 6,000. So where's the other 3,800 going?
Right. Yeah.
It's going to foreign governments. It's going to fund these other programs that the Democrats want to do. But most of that still is going to make it into people who want to buy groceries with it and pay their mortgages and stuff like that. That's going to move the consumer price index. And that's going to move interest rates. So that's what's on the bottom part of the panel there. Now let's take a close look at just the COVID relief on the next slide. I skipped ahead, but now we're there. So you would think Japan would take the lead, at least in the percentage of their GDP, but they're going to spend a little like 17% of their GDP on COVID. So that means buying the vaccines, paying for people being in the hospital for months and months and whatever. I mean, all this stuff that's just mind-boggling, that's awful, that's going on. But we are going to spend 25% of gross domestic product. So you add that all up, it's $5 trillion. That's a lot of money. So this really shows up in the money supply, and that's on the next slide. Now, we started using this slide a few weeks ago, and now I'm seeing it everywhere. But the average growth in the money supply is around between 6 and 7%. It's been 14% over the last decade. And you can see what happened when quantitative easing slipped in. The money supply started increasing, not overnight, but gradually. And that led to 14% per year growth. But this $5 trillion that's being printed right now is 27% growth in the money supply.
Wow.
Just the visual image of that is like, wait, that's
right.
a lot. So the 1.9 isn't in the economy yet, but it's sure looking like some number like that. And then there's another 2 trillion that's probably going to be spent on infrastructure, which is probably good. But yet it's more paper dollars coming into the economy. So the next slide, I love this slide. I doctored up a cartoon I found some years ago. So what's really going on here is we were rescued from a recession with quantitative easing. And that didn't move the inflation meter, the CPI meter, again, because that easing went mostly into the capital markets. But this COVID relief is definitely hitting us into the poop pit, the poop pit of inflation.
Poop pit, yeah.
So I just think I love the picture. Anyway, yeah. So
the outhouse, right?
The argument has been, I think it's still raging on, is we're going to get deflation. So on the next slide, and in fact, Larry Kotlikoff in our last show said, no, deflation is going to happen. That's going to happen first. And we'll see. There are a lot of deflationary pressures in play. The wealth concentration, the wealth divide is huge now. And that's been a result of this quantitative easing and the money printing. Banks aren't lending. The aging population has two edges to it. So it might not be deflationary. I'm going to talk about that on the next slide. Technological advances for sure. We're energy independent now. So those are deflationary, but the effect of just dumping trillions and trillions of dollars into the economy is eventually going to take its toll. And I think it will eventually cause inflation. It will tip the balance. And I do want to say something on the next slide that I just learned about that's sort of interesting. So one of our friends, Larry Siegel, wrote a book review on a book called The Great Demographic Reversal. And basically it speaks to the fact that as the baby boomers leave the workforce, there's going to be forces that cause wages to go up. There basically be fewer workers, especially fewer unskilled workers, because the skilled workers are already making way too much. The managers of companies are very well paid.
Yes.
But in terms of inflationary causes, this would be called cost push inflation. So the boomers leaving will cause salaries to increase. Biden's already talking about a $15 minimum salary, which, by the way, when you think about where that applies, it applies to the industries that are most hurt right now, basically restaurants and travel, entertainment. So anyway, that rise in wages will cause prices to increase because providers will have to increase their prices. The other one that I'm talking about with too much money in the economy is called demand pull inflation. So I think this book makes some good sense. It's certainly worth a read. So I think we're going to have two sources that are going to be driving up inflation: demand pull and cost push. So the next slide, I'm going to talk about what we can do to protect ourselves. And Marty, here's your thing. So the cryptocurrencies are just one of the things. Precious metals certainly have been a traditional way to. So they're in terms of substitutes for money. Precious metals have been a good store of value, but they're difficult as a means of exchange. I mean, you can maybe chip off a piece of gold and try to buy some bread or something, but that's sort of problematic. Larry Kotlikoff on the last episode said the best way to protect against hyperinflation is to keep working, and that's easy for him to say, but many of us, have worked enough, unless you really like what you're doing. So I'm doing that. And Kathy is too. We have a lot of fun. Tips could help, but just one of the things about getting protection against inflation with more pieces of paper is sort of problematic. So, but they certainly would help. We all have to eat, so commodities. But I just watched another show with a woman who basically said she's growing a farm in her backyard, so she's a survivalist, and she's capturing rainwater and doing all this stuff. Which
right.
I think. I hope, anyway, that we get some warning before we get to the stage where, we have to grow our own food and figure out how to harvest rainwater and stuff. But these things make sense. So you want to buy, especially farmland, real estate. And I'm told that Bill Gates and other really wealthy people have significant investments in farmland. So the smart money apparently is doing that. And then on the left-hand side, what I want to say is we are poking the bear. And Japan's out there, and I think ahead of us a little bit, but I think we're going to pass them pretty soon. So we started with $4 trillion of quantitative easing. We're going to probably add another 5 in COVID, and probably another 2 in infrastructure. That's 11 trillion. The entire economy is only 22 trillion. So it's getting scary bad.
Yeah, it really, really is. And I think the thing that bothers me the most, Ron, is the misinformation.
Well, Wall Street is incented to keep people invested.
Okay.
So, and they're a big, I mean, half the stuff I read is from Wall Street.
Mm-hmm.
And you sort of need to consider the source. But there are other things out there, and you keep sending me these videos, Ed. There are a lot of other people. They get 1 million views on theirs.
Yeah, so right.
I'd love to get 1 million views. But there are others out there who, I think they have ways to get paid, but it's not as obvious that they're trying to gaslight us.
Mm-hmm.
So I think there are counters to the gaslighting, and I think that's good. What I want to do is what I promised on the next slide. This is going out on the limb. But the bubble will burst. There's no doubt about it. But no, the questions that people are watching this show should say, so when will the stock market bubble burst? And I've been saying it for 3 years now, and it hasn't happened. How bad will it be? And then what about inflation? So I don't have the nerve to answer the when question, but I will say that Terry Dent has a video out, and he's saying it to everybody. The crash is coming. It's going to happen in April. It's going to last a decade. It's going to be at least 40%. And so you've got somebody who I think has credibility, although I think Harry has become sort of known as a perma-bear. But if you watch his video and listen to it, it's got a lot of the same stuff we just covered. So, but his forecast pinpointing it down to April is pretty brave, but I think it's imminent. And and all I'll say is every day that the market goes up another point or 10 points or whatever is a day where the bubble is getting bigger. And all that means is when it finally bursts, it's going to be a bigger burst. So when you come to the question, how bad, I think a 50% correction is not crazy. And again, it would take 45% correction to get us back to where we were last March, which in many people's opinion, including mine, was just the beginning of where the correction should have ended up. If it was only 20%, that would be, it would not be a burst at all. It'd just be a little deflation. In terms of inflation, I think we could get hyperinflation. I think that's really in the cards. It could certainly be 20% or more. And in the throes of an economy that's still trying to recover from a pandemic, we could certainly get stagflation again, which happened in the 1970s. And stagflation is where the economy is stagnant. It's not growing, but we're getting inflation at the same time. That's an unusual thing because you're not supposed to get inflation in a quiet economy. But most importantly, 78 million baby boomers are in the risk zone right now, most of them. And they could all be hurt simultaneously, and they all be hurt irreparably. And part of what I'm saying there is the typical time period to recover from a market crash is 4 years. So there may be enough time for baby boomers to recover if they will stay in. They probably won't. I mean, once they're burned, they'll probably be out. But the Great Depression lasted a decade. So baby boomers don't have the luxury of the time to sort of buy the dip or stay the course. It's just not in the cards. So to summarize,
you have another question here. Larry says, aside from inflation hedging, what are good downside strategies to avoid downside of stocks and bonds, such as annuities or some sort of structured products? And then he says, for the last 40 years, it seems we have had a long-term free ride with falling interest rates and large equity premiums with public U.S. stocks. So I get the 60-40 public equity and bond fix.
Yeah, it's been a good time. And that's going to end. I hesitated to say some of these. So annuities are probably really a good thing, but it's just sort of worrisome that the interest rates are so low. And sort of this thought that, if interest rates start going up, you're going to be sitting there with an annuity that's paying you, if it's paying you $1, it'd be worth 30 cents. So that it's an issue of timing, but they are good things. What I didn't say though, here we go. Should new models be 60 private equities, 40 other like 5 crypto? Yeah, I'm not sure. And if I knew what to do, I'd probably just. I'm doing some of it personally, but I'll tell you some of what I'm doing personally is high risk, but it's betting against the stock market and betting against the market. Yeah.
Okay, so we have another thing here, Ron, from Churchill. Thanks for joining us.
Yeah, the
number of companies that have gone public since the beginning of 2020 with negative earnings is another provocative piece of data. Can't find the number. Nice job.
Yeah. So it's crazy. I mean, you're sitting here going, there's a lot of things I can see for sure are wrong with this picture, but then you hear, even bad news, and the stock market goes up, and you just that makes your hair hurt. This makes your hair hurt.
Yeah.
Anyway, so we're definitely up against our 1 hour time, Kath. So let me.
Okay, I'll go to the next slide.
Yeah, let's skip that one and just go to.
Okay.
So we say this in almost every episode of this, but 60-40 for baby boomers is not even a little bit smart. We have been advocating that you protect your assets, and it would be 70% in safe assets, but That is not cash anymore. That has got to be something else, and it could be precious metals. It could be tips. It could be a lot of things. But just I think you need to start thinking outside the box. And most importantly, we've said this over and over again. You should trust but verify your financial advice. And I think many of the boomers don't really know how they're invested, but it wouldn't surprise me. And I just say it this way. EBRI, the Employee Benefit Research Institute, says the average baby boomer is invested 60-40. But it's even more interesting than that. The average 20-year-old is invested 60-40. The average 40-year-old is invested 60-40.
Yeah. Right.
The average is the same regardless of age.
Isn't that crazy?
Well, and I think Marty hit on it. 60-40 was fine for the prior 10 years, but it's not good now. It's definitely not good for baby boomers. So the last slide would just remind people that we're here to help. We get paid a little bit if you use our help. So we have 8-Stage Robo, which is a self-help. It's for do-it-yourselfers. Glide Path Wealth Management, we have an investment consultant who we work with, who will work with you. Please watch our library. We now have 25 episodes, 25 articles. So let me put it this way. If you have a question about how to invest, you can probably get an answer in the video or an article in less than an hour. So we probably haven't covered it all, but if there's something that you're interested in, you'd like us to, let us know. And then institutional investors, we manage the SMART funds, which are target date funds on Hand Benefit Trust in Houston. So that's it. We really appreciate your listening, and please like us and follow us.
Yeah, thanks, Marty. Thanks for everybody for all the interaction. He says,
thank you.
Love how you both interact here, Ron. Great program. Keep them coming.
Yeah, thank you.
Okay. Do you think you want to tell everybody, Ron, that we're going to be expanding the program now too?
Well, we're talking about getting the word out, and anything you on this call could help us. So as I said earlier, I'm watching these shows and they get 1 million viewers, and we're getting our most watched shows get thousands, not millions. So we're going to try to set up a website and really promote the show, and
we'll need your help. So any suggestions you might have would be great, because it all depends on you watching and sharing.
Yep.
If you feel this information is valuable, please do that. And actually, the website will be called babyboomerinvesting.show.
There you go. Yep.
So stay
Looking forward to that.
Okay, everyone.
Thanks. Thank you.
Okay. We'll, let me see here. Okay. Bye.